Feeling like you're constantly bombarded with financial news that just doesn't quite connect. Or maybe you're the kind of person who looks at the global economy and wonders, how it all fits together.
Yeah.
You're definitely in the right place. Today, we're offering you a focused look at some really intricate and interconnected ideas without all the usual noise.
That's it. Forget the endless scrolling and those headlines that seem to contradict each other every other day.
Right.
We've gone through a detailed set of Reddit posts for you, a really comprehensive analysis called The Dollar Endgame by someone using the name Peruvian Bull. Think of it as a deep dive from a unique perspective, and we're here to pull out the crucial insights for you.
Our main goal for you today is to really grasp the current powerful position of the US dollar, to understand the built-in dangers within the system, and maybe explore some echoes from the past that might give us clues about what could happen next.
Exactly.
And we want to do this in a way that's clear and engaging, not buried under layers of finance jargon. We're aiming for those aha moments where things click into place.
Right. We're going to trace the journey of the dollar to becoming the world's reserve currency, unpack the tricky challenges and paradoxes. It creates a big one, being the Triffin dilemma, which is, well, fascinating. And look at how financial tools like derivatives add layers of complexity. We'll also get into how the banking system and debt cycles work, and even take a serious look back at the hyperinflation in the Weimar Republic to see if there are any relevant lessons for today.
Okay, let's do it.
So let's get started.
Okay, so the author begins by putting us in the shoes of someone like, say, President of Liberia, who wants their country to be more involved in global trade. What kind of advice would they likely receive from an international body like the IMF?
Well, the standard advice would almost certainly be to establish their own currency and, critically, a central bank.
The central bank.
Yeah. Yeah. This gives a nation its own legal tender, the ability to manage its monetary policy, things like interest rates, and a crucial lender of last resort for its banks. These are generally seen as essential building blocks, for a modern economy to function within the global financial system.
Which then leads us to this idea of dollar hegemony. How did the US dollar become this dominant currency for international trade and the primary chase for countries holding their reserves?
It's a story with several key chapters, really. One major part is the Bretton Woods Agreement after World War II, where the dollar was pegged to gold, and other major currencies were then pegged to the dollar.
Right, Bretton Woods.
Even though that direct link to gold ended in 1971, the dollar's strong position in global trade remained, and it was significantly boosted by what we call the petrodollar system.
The petrodollar system. Can you remind us of the core idea there?
Sure. Originally, it very specifically referred to Saudi Arabia agreeing to price all of its oil exports exclusively in U.S. dollars.
Just Saudi Arabia initially.
Initially, yeah. But over time, the term has broadened to generally mean that most oil contracts between countries that are not the U.S. are still priced in USD.
Interesting.
This creates a continuous and significant demand for dollars because countries need to have dollars to buy oil, which is, of course, a fundamental global commodity. So essentially, this created a consistent artificial demand floor for the dollar, gave the U.S. significant leverage.
Right, and the author even brings up something that might seem counterintuitive, those trade deficits that we often hear politicians complaining about.
Oh, yeah.
He suggests that these were almost a natural consequence of the dollar being the world reserve currency. How does that work?
Exactly. It's a bit mind-bending at first.
Yeah.
As the world reserve currency, the U.S. had to supply the rest of the world with dollars to facilitate international trade and allow other countries to build up their own reserves.
So how do you supply dollars? By buying things.
Precisely. The primary way this happened was through the U.S. importing more goods than it exported, essentially pushing those dollars out into the global economy. The author sadly points out that one of the domestic consequences of this was the deindustrialization of the American heartland as manufacturing jobs moved overseas to satisfy that global demand for U.S. goods paid for with those dollars going out.
So the very success of the dollar as the global currency sowed the seeds of potential instability, a true catch-22.
Absolutely. A definite catch-22.
So it seems like this benefit of having the WRC status in the short term came with some pretty significant long-term costs domestically. And this brings us to a really critical concept, the Triffin dilemma. What's the central conflict at play there?
The Triffin dilemma, named after economist Robert Triffin, really highlights the inherent conflict for a country whose currency is the global reserve. It was fascinating.
How so?
On one hand, to fulfill its role, The issuing country needs to run these deficits, like we just discussed, to supply the world with its currency.
Right, push the dollars out.
But on the other hand, this inevitably leads to a growing accumulation of debt over time, which then raises questions about the long-term stability and value of that currency. The core insight here is that no country can maintain the position of WRC holder indefinitely because the very act of fulfilling the role undermines its long-term sustainability.
It's a bit of a no-win situation, isn't it?
Pretty much seems that way long-term.
Now, the author includes a graphic showing us the relative sizes of different countries based on their foreign exchange reserves. What's the main thing we should take away from that visual?
What that graphic powerfully illustrates is just how much foreign currency assets various countries hold, and the crucial point is that the vast majority of these reserves are held in U.S. dollars.
So mostly treasuries?
Typically in the form of U.S. Treasury bonds, T-bills, and other U.S. government debt, yeah. It really underscores the dollar's continued dominance as the primary reserve asset held by central banks around the world.
And this dominance seems to be further reinforced by the SWIFT network. Tell us about what SWIFT is and the part it plays in all of this.
SWIFT, the Society for Worldwide Interbank Financial Telecommunication, is essentially the backbone, the plumbing of international payments.
Okay, the messaging system.
It's the secure system that most multinational banks, financial institutions, and major corporations use to settle trades and move money across the globe. Because the USD is the overwhelmingly preferred currency for these transactions within SWIFT, the author mentions a 2014 report indicating that nearly 80% of world trade was denominated in USD.
Wow, 80%.
Yeah, it essentially makes it necessary for other countries to use the dollar in international deals, even when they are trading directly with each other, not involving the U.S. at all.
So even if, say, Brazil and Argentina are trading agricultural goods, they likely have to do it using dollars. Why is that the case?
Exactly. A bank in Brazil might not want to hold a large amount of Argentine pesos because the market for that currency might be smaller and less liquid.
Right, harder to trade.
If they then need to convert those pesos into a more widely accepted currency, they could face unfavorable exchange rates and potential losses. By pricing and settling the transaction USD, the contract is more easily understood and accepted globally, and the Brazilian bank knows it can quickly and easily convert those dollars if needed. Makes things smoother.
The author then introduces us to these terms dollarization with a lowercase d and dollarization with a capital D. What's the key difference we should understand?
Good distinction. Lowercase dollarization refers to the broader trend we've been discussing, the widespread use of the dollar as the main currency for pricing contracts and settling transactions, even when the parties involved are not U.S. entities.
So just using dollars in contracts.
Right. Capital dollarization, on the other hand, is a much more significant step where a country officially adopts the USD as its sole legal tender, essentially giving up its own national currency altogether.
Like Panama.
Ecuador, El Salvador, and Panama are examples of countries that have made this official switch.
And all of this has led to the creation of eurodollars. What exactly are they?
Eurodollars are U.S. dollar-denominated deposits held in banks that are located outside of the direct jurisdiction of the United States. So dollars held in London or Tokyo, for example.
Outside U.S. control.
Essentially, yeah. Their growth is very closely tied to the rise of the petrodollar system. As countries that exported oil accumulated large amounts of USD, these dollars often ended up being deposited in overseas bank accounts, putting them beyond the direct control of the U.S. Treasury or the Federal Reserve. By 2016, the eurodollar market was estimated to be massive, something like $13.83 trillion.
Wow, that's huge. This paints a picture of really significant U.S. financial power. The author then connects this financial power to overall U.S. global influence, including its military presence around the world.
Yes, the author argues that the dollar's position as the global reserve currency has enabled the U.S. to project immense military power globally. The continuous demand for dollars has allowed the U.S. Treasury to borrow and spend on a scale that would be, well, unthinkable for most other nations.
Financing the military network.
Exactly. Financing a vast network of military bases and enabling the U.S. to be involved in conflicts across the globe. He points out that the U.S. has been in a state of near continuous warfare despite not formally declaring war since 1941.
And with over 800 U.S. military bases dotted around the planet, it's hard to argue with that point about global reach. He even draws an interesting comparison to the Roman Empire, calling the U.S. a new Rome. What's the basis for this analogy?
The author observes that several American institutions, from the Senate and the presidency to the court system, bear striking resemblances to their ancient Roman counterparts. Even the national symbol of the U.S., the eagle, mirrors the Roman aquila.
Yeah, you can see that.
However, he urges us not to have a purely celebratory view of Rome.
He highlights a less glorified side of the Roman story, doesn't he?
Exactly. While we often hear about Rome's military triumphs and impressive engineering, many historians also point to the internal factors that contributed to its long decline. A ruling elite that became detached from the concerns of ordinary citizens, growing inequality, environmental problems, political corruption, social decay, and widespread economic hardship.
Sounds familiar, unfortunately.
The author suggests that these are potential pitfalls of immense, unchecked power that, the U.S. should be aware of.
He even mentions the Roman practice of currency debasement, this idea of clipping coins. How did that contribute to the empire's eventual decline?
Facing mounting debts from its numerous military campaigns, the Roman treasury began to reduce the amount of precious metals in its coins, literally shaving bits off or mixing in cheaper metals. This practice, clipping or debasement, was an early form of devaluing the currency.
Inflation, basically.
Pretty much. It meant that the Roman denarii gradually lost significant value each year, contributing to economic instability, unrest in the provinces, and ultimately the weakening of the empire from within. A detached elite debasing the currency for short-term gain at the expense of long-term stability, a sobering historical note.
Definitely food for thought. Okay, let's shift gears now and delve into what the author calls the Ouroboros, this symbol of a snake eating its own tail, which he uses to represent the potentially self-destructive nature of feedback loops within the financial system, specifically when it comes to derivatives. For someone who might not be familiar, what exactly are derivatives?
Okay, derivatives. In simple terms, they're financial contracts where their value is derived from the performance of an underlying asset or benchmark.
Derived, hence derivatives. Makes sense.
Right. These underlying assets can be incredibly diverse. Everything from stocks and bonds to commodities like oil or gold, currencies, interest rates, even market indexes. The derivative itself is essentially a bet or an agreement between two or more parties, and its price will fluctuate based on what happens with that underlying asset.
It's like a side bet.
Think of it as a side bet on the outcome of something else, yeah.
He uses a poker game analogy to illustrate how derivatives can create bets on bets and really amplify leverage. How does that work?
Imagine you're betting on a poker game who's going to win. That's bet like a basic derivative.
Okay.
Now imagine someone else comes along and bets on the outcome of your bet.
Okay.
That's a second-order derivative, a bet on a bet. This process can theoretically keep going, especially with over-the-counter OTC derivatives, which are private agreements. Each of these layers of bets creates leverage,
Leverage meaning?
meaning a relatively small move in the underlying poker game or asset can lead to much larger percentage gains or losses for those holding these derivative contracts. It's like using a small amount of money to control a much larger potential outcome. Amplifies things.
Now, the initial idea behind derivatives wasn't all about creating this kind of amplified risk, right? They were originally intended to help people manage risk through something called hedging. Can you explain that?
Correct. That was the original idea anyway. Hedging is a strategy used to offset potential losses in one investment by taking a position in another that is expected to move in the opposite direction.
Like insurance?
Sort of, yeah. Derivatives were initially developed as tools for traders and investors to manage their gross exposure, the total value of their holdings, and convert it into a net exposure, which reflects the difference between their long positions, bets that an asset will go up, and short positions, bets that it will go down. The idea was that by carefully balancing these positions using derivatives, they could theoretically reduce their overall vulnerability to market swings.
But the also outlines three main ways that derivatives can actually lead to serious systemic problems. Let's start with counterparty risk. What exactly is that?
Counterparty risk is simply the risk that the other party you have a derivative contract with will fail to meet their obligations.
They won't pay up.
Exactly. This usually happens if they go bankrupt or become unable to pay. If your counterparty collapses, the derivative contract you hold can suddenly become worthless.
Ouch.
Yeah. This is a major concern, especially with over-the-counter OTC derivatives, which are private contracts negotiated directly between two parties and aren't guaranteed by a central clearinghouse, unlike derivatives traded on a formal exchange.
So more risk with OTC.
Definitely more counterparty risk, yes.
The second way derivatives can cause trouble is through the failure of the underlying asset. How does that play out?
This one is pretty straightforward, sadly. If the fundamental asset that a derivative's value is based on suddenly crashes in value, then all the related derivatives that are tied to it will also become worthless or close to it.
Like in 2008.
The 2008 financial crisis is a perfect and painful example of this. The collapse of the U.S. housing market led to the failure of mortgage-backed securities, MBS, those bundles of home loans.
Right.
These then form the basis for even more complex derivatives like collateralized debt obligations, CDOs, synthetic CDOs, and credit default swaps. All these intricate bets ultimately became worthless when the underlying mortgages began to default en masse. Domino effect.
And the third way is through something called cross-collateralization or rehypothecation. That sounds particularly complicated and potentially risky.
It is quite complex and definitely introduces a lot of risk. Rehypothecation is the practice where banks and brokers take assets that their clients have posted as collateral, to back their trade.
Collateral.
Your collateral, yes. And then they use those same assets for their own purposes, including pledging them as collateral for their own borrowing or for other trades.
Wait, they use my collateral for their stuff?
Yes. And it gets worse. This can even involve pledging the same asset to multiple different parties at the same time.
That sounds...
It essentially creates more claims on an asset than actually exist. This is quite common in futures markets, where, for example, large bullion banks might sell many more futures contracts for an ounce of gold than they physically hold.
So if everyone wants their gold.
If all those contracts suddenly demanded physical delivery of the gold, a contract delivery squeeze would occur. And if the bank couldn't deliver, all those unfulfilled contracts would become worthless. Big problems.
The author then takes a moment to clarify the difference between the notional value and the market value of derivatives, using a call option as an example. Why is understanding this distinction so important?
Right, this is key. Notional value represents the total underlying value that the derivative contract is referencing. In the example of a call option on the 100 shares of a stock at a certain price, the notional value would be that price multiplied by 100.
The value of the underlying shares.
Exactly. Market value, on the other hand, is the actual current trading price of the derivative contract itself, what it costs to buy or sell that option right now. The key here is that the notional value can be many, many times larger than the market value of the contract. This highlights the enormous underlying exposure and potential risk that can be created by derivatives, even if the initial cost of buying the contract seems relatively small.
Like controlling a huge amount with a small payment.
Precisely.
Yeah.
Which amplifies both potential gains and potential losses massively.
He then uses a pretty striking analogy comparing derivatives to nitroglycerin. Can you explain what he means by that?
It's a powerful image. The analogy is really meant to emphasize the hidden and compounding dangers within the derivatives market.
How so?
A single bottle of nitroglycerin, if handled carefully, might not seem too threatening. But if you have vast quantities of it, all interconnected by potential triggers, the risk of a catastrophic chain reaction increases exponentially.
Okay, I see.
Similarly, the interconnectedness of financial institutions through these complex webs of derivative contracts creates a system where the failure of just one major player can rapidly spread and destabilize the entire global financial system. One small shock can set off a huge explosion.
This leads us directly to the concept of systemic risk. How exactly do derivatives contribute to this kind of widespread risk?
Systemic risk is the danger that the failure of one financial institution can trigger a cascade of failures across the entire interconnected financial system, much like dominoes falling.
The whole thing comes down.
Potentially, yes. Derivatives are a major contributor to this because they create these incredibly complex and often opaque webs of obligations between different banks, investment funds, and other financial entities. The recent collapse of Archegos Capital, a hedge fund that used something called total return swaps,
I remember that.
right, that led to billions of dollars in losses for its counterparties like Credit Suisse, illustrating how quickly and unexpectedly this kind of contagion can spread.
The sheer size of the derivatives market is often quoted as being absolutely enormous, almost incomprehensible. What kind of numbers are we actually talking about?
The numbers are staggering. The Bank for International Settlements, BIS, which is kind of the central bank for central banks, estimated the notional value of the over-the-counter OTC derivatives market alone to be around $640 trillion in 2019.
640 trillion.
Trillion, yes. And some estimates for the total global derivatives market, including those traded on exchanges, go even higher, potentially north of $1 quadrillion.
A quadrillion. That's 1,000 trillion.
It is. To really grasp that scale, the entire global economy is estimated to be around, what, $88 trillion. So the face value of these derivative contracts dwarfs the actual real-world economic activity.
That's insane.
Even individual banks can have staggering notional exposure. Deutsche Bank, for example, has been reported to have over $47 trillion in notional gross exposure.
But the author points out that through financial engineering, institutions can sometimes show a low net exposure despite these massive gross exposures. How does that potentially mask the true level of risk in the system?
Right, this is where it gets tricky. Financial engineering involves using various hedging strategies to try and offset different positions. While this can indeed reduce net exposure, which is your overall directional bet on the market, it doesn't eliminate the underlying gross exposure, the total amount of value that's at risk.
So the total danger is still there.
The total potential danger is still lurking. The problem is that these hedging strategies can sometimes fail, especially during periods of extreme market stress. The case of AIG during the 2008 crisis is a prime example.
What happened there?
They had insured vast amounts of mortgage-backed securities through credit default swaps, leading to huge gross exposure, but their net exposure appeared much smaller according to their risk models. Those models, however, ultimately proved to be woefully inadequate when the housing market collapsed. They were on the hook for way more than they thought.
Given all these potential ticking time bombs, the natural question is, why hasn't the whole system imploded yet? What's keeping it going?
That's the quadrillion-dollar question, isn't it?
Yeah.
The author suggests that a primary reason is the continuous flow of new money into the financial system, which he somewhat cynically refers to as the casino.
Meaning central bank money.
Largely, yes. As long as central banks continue to inject liquidity, either through low interest rates or by directly purchasing assets, quantitative easing, which we'll discuss, asset prices tend to rise, and trading in derivatives remains profitable for the participants. In many ways, it's a confidence game.
Keep the music playing.
As long as that confidence is maintained and the money keeps flowing, the trading continues.
Warren Buffett famously described derivatives as financial weapons of mass destruction. That's pretty stark and memorable warning.
It is a very stark warning, and they also reminds us of just how close the system came to a complete meltdown back in October 2008. He even quotes Timothy Geithner's very concerning statement that ATMs were perhaps only days away from not working.
Wow, days away.
It really underscores the incredibly interconnected and fragile nature of the financial system due to these derivatives.
And despite this near miss, the author argues that regulations in the OTC derivatives market are still not robust enough and that banks continue to rely on risk models that might have fundamental flaws.
Yes, that's a key point. The over-the-counter OTC derivatives market remains significantly less regulated than exchange-traded markets, making it difficult to get a complete picture of the overall systemic risk that's building up.
Hidden risks.
Hidden risks, exactly. Furthermore, many financial institutions rely heavily on complex risk models, like value at risk, RER, and the assumptions of the efficient market hypothesis, which have been shown to underestimate the probability of extreme, so-called black swan events. This can create a false sense of security and lead to a continued accumulation of these hidden risks.
Finally, he touches on these positive feedback loops that can be created by things like index arbitrage, counterparty risk, and short selling. How do these actually amplify market movements, especially during times of crisis?
These mechanisms can indeed create vicious cycles. For example, in index arbitrage, traders try to profit from tiny price differences between an index future, like the S&P 500 future, and the actual underlying stocks in the index.
Okay.
During periods of market stress, this can lead to coordinated selling pressure in those underlying stocks as arbitrageurs try to close out their positions, which can further drive down the index futures, creating a negative feedback loop. Selling begets more selling.
And counterparty risk adds to that.
Absolutely.
Yeah.
If one counterparty in a derivative trade defaults, it can trigger margin calls and potential defaults at other interconnected institutions, amplifying the initial shock. The author even mentions Black Monday in 1987 as an example where strategies like portfolio insurance combined with index arbitrage contributed to a very rapid and severe market crash. These loops can really accelerate a downturn.
It paints a rather intricate and, frankly, somewhat unsettling picture of the global financial system. Let's move on to part 3 of the author's analysis, which he titles The Money Machine, where he focuses on debt cycles and the mechanics of our modern banking system. He starts by explaining fractional reserve banking. Can you give us a quick rundown of how that system operates?
Sure. Fractional reserve banking is really the core of how most modern banks lend money and, in the process, create more money in the economy. It's fundamental.
How does it work?
When you deposit money into a bank, the bank is only required to keep a small fraction of those deposits on hand in reserve, readily available for withdrawals.
Okay, just a fraction.
Right. The remaining larger portion can then be lent out to other borrowers. This is where the money machine effect comes in. When that loan is deposited into another account, that bank can then also lend out a fraction of it, and so on,
So the money multiplies.
in a sense. The author uses a simple example to show how an initial $1,000 deposit can seemingly expand to over $3,400 in total accounts throughout the system. Although it's crucial to remember that most of this new money exists as debt or credit, not physical cash.
So the vast majority of what we think of as money isn't actually physical cash sitting in bank vaults, is it?
That's absolutely right. The overwhelming majority of the money supply in a modern economy exists in digital form, as entries on ledgers, essentially debt or credit circulating within the financial system. Physical cash is only a very small part of the total money supply.
The author then goes on to discuss debt cycles, making a distinction between long-term super cycles and the more frequent, shorter, normal cycles. What's the typical time frame and some key characteristics of each?
Right, the cycles. Long-term debt supercycles are really significant periods of debt accumulation that can last anywhere from 50 to 80 years. Big waves.
50 to 80 years. Wow.
Yeah, they typically involve a major buildup of debt across various sectors of the economy, often fueled by new innovations or economic paradigms, and they eventually reach a point where the debt burden becomes unsustainable. Then get a major reset.
And the short-term cycles.
Short-term or normal debt cycles are more cyclical, occurring roughly every 8 to 10 years. These are more like the typical business cycle, involving the natural expansion and contraction of credit availability in response to economic conditions and monetary policy, ups and downs.
He then outlines 4 phases of a typical credit cycle: expansion, peak, contraction, and trough. What are some of the defining features of that initial expansion phase?
During the expansion phase, things are generally looking up. The economy is doing well, consumer and business confidence is high, and banks become more willing to lend money.
Money is easy to get.
Exactly. This easier access to credit encourages businesses to invest and grow, and consumers to borrow and spend, leading to increased economic activity and usually rising financial leverage. The boom times.
He then touches on historical banking panics in the U.S. before the creation of the Federal Reserve and mentions this issue of fictitious reserves leading up to the Great Depression. What exactly were those?
Fictitious reserves, yeah. In the period leading up to the Great Depression, there was a somewhat problematic practice where banks would count checks that had been deposited but hadn't yet cleared, meaning the money hadn't actually been transferred from the payer's bank.
So the check was still floating.
Right, it was floating. They'd count that float as part of their readily available cash reserves. These floating checks were essentially being counted by both the bank where they were deposited and the bank they were drawn on, creating an illusion of having more reserves than they actually did.
Double counting.
Exactly. This system of fictitious reserves made the banking system particularly vulnerable to runs and failures during times of economic stress. It's a bit like rehypothecation in the modern era, more claims on the same underlying asset than truly exist.
And before the Federal Reserve was established, there was a real inability for banks to easily access and mobilize reserves during times of crisis. How did that inability actually worsen banking panics?
Before the Fed, each individual bank largely operated independently in terms of its reserves. They'd hold cash in their own vaults or perhaps have deposits in correspondent banks and larger financial centers.
It's decentralized.
Very decentralized.
Right.
But this system made it very difficult for banks facing sudden withdrawals, a bank run, to quickly access additional reserves to meet those demands. And the correspondent banks themselves could also be facing similar pressures, creating a bottleneck.
So no backup.
Pretty much no reliable backup. This often led to widespread bank failures as people lost confidence and rushed to withdraw their deposits. Contagion spread easily.
This inherent fragility in the banking system was a key motivator behind the creation of the Federal Deposit Insurance Corporation, the FDIC. What's its dual impact, both protecting depositors but also potentially leading to banks taking on more risk, this idea of moral hazard?
Right, the FDIC. It was established to insure bank deposits, initially up to a certain limit, now $250,000 per depositor per insured bank. The primary goal was to protect individuals from losing their savings if a bank failed.
Prevents bank runs.
Exactly. Helps maintain confidence. However, this insurance also creates what economists call moral hazard.
Moral hazard.
Knowing that their depositors are protected, banks may feel less pressure to be overly cautious. They could be incentivized to take on riskier investments and lending practices because they are not solely bearing the potential consequences of those risks. The FDIC, and ultimately taxpayers, would step in to cover insured depositors if things went bad.
So less skin in the game for the banks.
In a way, yes, the risk is partially socialized.
The author also discusses the repeal of the Glass-Steagall Act in 1999 and the subsequent rise of too-big-to-fail institutions. Can you explain the connection there?
Yeah, Glass-Steagall is important here. Passed in the aftermath of the Great Depression, it put a legal separation between commercial banks, the ones that take deposits and make loans, and investment banks, the ones underwriting securities and trading.
Kept boring banking separate from risky banking.
That was the idea, yeah.
Huh.
Prevent the riskier activities from jeopardizing customer deposits. Its repeal in 1999 allowed for the creation of massive financial conglomerates that combine these activities under one roof. Think Citigroup merging, for instance.
Universal banks.
Right. The concern then became that the failure of any one of these enormous, highly interconnected institutions could pose a systemic risk to the entire global financial system. This led to the concept of too big to fail.
Meaning they had to be bailed out.
Exactly. The expectation grew that governments would have no choice but to step in and bail them out during a crisis to prevent a wider collapse, regardless of the behavior that led to the crisis in the first place. More moral hazard, really.
We certainly saw that play out during the 2008 financial crisis. What was the government's response, including things like TARP and the Federal Reserve's quantitative easing, or QE?
The response was indeed unprecedented in scale. The government implemented programs like the Troubled Asset Relief Program, or TARP, which was designed to bail out failing financial institutions by purchasing their toxic assets, mostly those bad mortgage-related securities.
Buying the bad debt.
Essentially, yeah.
Yeah.
At the same time, the Federal Reserve engaged in a policy called quantitative easing, or QE. This involved the Fed electronically creating new money to buy assets like mortgage-backed securities, MBS, and U.S. government bonds.
Why buy those assets?
The main goals were to inject liquidity back into the frozen financial system banks weren't lending to each other, and to lower long-term interest rates to encourage borrowing and investment. The author correctly points out the very significant increase in the U.S. government debt-to-GDP ratio during and after this period, reflecting the scale of these interventions.
Can you explain the actual mechanics of QE a little more clearly? How is it different from, say, a pension fund or another institution buying bonds?
Good question. When a typical institution like a pension fund buys a bond, they are using existing money, maybe savings from investors or profits. It's essentially a transfer of money from one party to another. It doesn't inherently create new money in the system.
Okay, just moving existing money around.
Right. However, when the Federal Reserve engages in QE, it doesn't use existing funds. Instead, it essentially creates new money out of thin air on its balance sheet by crediting the account of the seller, usually a commercial bank.
Creates money electronically.
Exactly. So when the Fed buys those mortgage-backed securities or treasury bonds from banks, it's directly increasing the amount of bank reserves in the financial system and expanding its own balance sheet.
Oh.
The author notes that the Fed printed around $2 trillion in the 2 years following the 2008 crisis through this mechanism.
No. This massive increase in the money supply after 2008 didn't lead to the kind of traditional inflation in consumer prices that many economists have predicted. Why was that the case, according to the author, who references the analysis of Lynn Alden?
Right. That puzzled a lot of people. The author explains, referencing Lynn Alden's work, that a key reason we didn't see runaway consumer price inflation is that most of this newly created money didn't actually flow into the real economy, the markets for everyday goods and services that we consume.
So where did it go?
It largely stayed within the banking system as reserves. Banks were hesitant to lend aggressively in the aftermath of the crisis, and they used these new reserves to shore up their balance sheets to recapitalize and become more stable.
So they plugged holes in the banks.
Pretty much, yeah. And a portion of the new money that did leave the banking system primarily flowed into the financial economy, the markets for bonds, stocks, real estate, and other financial assets.
Asset price inflation.
It's exactly. Leading to significant asset price inflation. The prices of things like stocks and real estate went way up. But the prices of your groceries and gas didn't skyrocket in the same way, at least not initially.
This phenomenon gave rise to the wealth effect theory. What is that, and who did it end up disproportionately benefiting?
The wealth effect is the idea that as people's perceived wealth increases, for example, due to rising stock market values or home prices, they will feel more financially secure and therefore be more inclined to spend and invest more.
Which boosts the economy.
That's the theory, yeah. It's
Yeah.
supposed to stimulate the broader real economy. However, the author points out that since the wealthiest 10% of the population owns a very large majority of the financial assets, particularly stocks, this wealth effect disproportionately benefited the already wealthy.
So increased inequality.
It certainly appears to have exacerbated existing wealth inequality, while the economic growth for the rest of the population remained relatively stagnant for a long time.
He also highlights a disconnect between the valuations of financial assets and the underlying real economy, using the example of a high price-to-earnings ratio for a company like Square.
What's the point he's making there?
The point is that when you see companies trading at extremely high price-to-earnings PE ratios, it suggests that investors are paying a very high premium for their earnings,
Yeah.
often based on expectations of very high future growth, maybe unrealistic expectations.
It's like the dot-com bubble.
Some parallels, yeah. If you look at the overall growth rate of the real economy, these valuations can seem disconnected from fundamental economic realities. In the case of Square, a high PE ratio, even if it were to pay out a dividend, would imply it would take an incredibly long time for investors to get their initial investment back through those earnings alone.
So what's driving the prices?
It suggests that asset prices are often being driven by factors other than just underlying economic performance, such as the massive amounts of liquidity that have been pumped into the financial system by central bank policies like QE. Too much money chasing too few good assets, perhaps. To further try and stimulate borrowing and consumption after 2008, interest rates were lowered to near 0% for an extended period. What was the intended effect, and what have been some of the longer-term consequences?
The intended effect of lowering interest rates to near zero, or ZRRP, zero interest rate policy, was to make borrowing cheaper for businesses and consumers.
Make loans cheap.
Exactly. Theoretically encouraging them to take out loans, invest, and spend, which is crucial for an economy where consumer spending makes up such a large portion of GDP, like 70% in the U.S.
Did it work?
Well, one of the long-term consequences, the author notes, is a massive buildup of debt across various sectors of the U.S. economy, as borrowing became incredibly attractive. It also potentially fueled some of the asset price inflation we just discussed, as investors hunted for higher returns in a low-yield world, created new distortions.
He even brings up the near collapse of the hedge fund long-term capital management LTCM back in 1998 due to excessive leverage and derivative bets requiring a Fed-organized bailout. Why is this an important historical parallel to consider in this discussion?
LTCM in '98 is a really crucial precursor. Its near failure serves as a stark reminder of the inherent dangers of excessive leverage and the interconnectedness of the financial system, even before the massive expansion of the derivatives market that followed.
A warning sign.
Definitely. It also highlights a recurring pattern. When the financial system faces a significant threat that could lead to widespread contagion, the Federal Reserve often feels compelled to step in and orchestrate some form of intervention or bailout to prevent a broader collapse. Sets a precedent.
And all of this brings us to what the author sees as a stark choice at the end of this long-term debt supercycle, either hyperdeflation or hyperinflation. Can you explain these two very different potential outcomes?
Right, the endgame scenarios, according to this analysis.
Where?
Hyperdeflation would involve a widespread and rapid contraction of credit, leading to mass defaults on loans and a sharp decline in the general price level as demand collapses. Think debt collapse.
Like the Great Depression.
That's the kind of scenario, potentially leading to a prolonged economic depression, yes. Hyperinflation, on the other hand, would be characterized by a rapid and uncontrolled increase in the money supply, leading to a drastic devaluation of the currency and a runaway increase in prices for goods and services.
Like Weimar Germany.
Exactly, as we saw in the historical example of the Weimar Republic. The author argues that these are the two primary and very different ways that this massive accumulation of debt and the current state of the monetary system could ultimately resolve, either a collapse in debt or a collapse in the currency.
This really sets the stage for part 4 of the author's analysis, which he aptly titles Financial Gravity and the Fed's Dilemma. He starts this section with an interesting analogy of ships of trade navigating between a waterfall of deflation and the hellfire of inflation. What's the significance of this image?
It's a vivid image, isn't it? The analogy depicts the precarious situation of the global economy. These ships of trade represent the interconnected economies of the world, sailing a narrow and dangerous strait.
Between two bad outcomes.
Precisely. On one side lurks the waterfall of deflation, representing the risk of a severe economic downturn caused by debt defaults and contracting credit. On the other side is the hellfire of inflation, symbolizing the danger of runaway prices caused by excessive money printing.
And the ships are linked.
Yes, the fact that these ships are linked by trade and investment emphasizes the interconnectedness of the global system. The risk is that if one major economy veers too sharply towards either extreme, it could drag others down with it, highlighting the systemic risks we've been discussing. Nowhere to hide.
He then delves into the historical example of the aftermath of World War I and the impact of the Treaty of Versailles on Germany, arguing that it really set the stage for the hyperinflation that followed. What were some of the critical economic factors at play there?
Right, the Weimar example is crucial here. The Treaty of Versailles imposed incredibly harsh economic reparations on Germany, forcing them to pay massive sums to the Allied powers. Huge war debts, yes. This, coupled with the loss of significant industrial territory like the Ruhr and the cost of demobilization and rebuilding after the war, created enormous financial strain on the German government. They faced massive budget deficits.
How did they pay?
Well, instead of raising taxes significantly, which was politically difficult, or defaulting on their obligations, they increasingly resorted to financing these deficits by simply printing vast quantities of money at the Reichsbank.
The printing press solution.
The seemingly easy way out, which turned out to be catastrophic.
And this printing of money, which might have seemed like a temporary fix, eventually led to this devastating inflationary feedback loop. Can you explain how that vicious cycle took hold in Weimar Germany?
Yet a classic feedback loop. As the German government continued to print more and more money, the paper mark, people in Germany began to realize that the value of their currency was rapidly declining.
Lost confidence.
Exactly. This led to a rise in inflation expectations. People started trying to spend their money as quickly as possible before it lost even more value, the hot potato effect.
Get rid of it fast.
Right, which in turn increased demand for goods and services, further driving up prices. This created a self-reinforcing cycle. Rising inflation expectations led to increased spending velocity, which led to even higher inflation, validating those initial expectations and making the problem spiral out of control.
He also mentions the incredibly rapid increase in the velocity of money during the Weimar hyperinflation. Why is that such a significant indicator of a currency crisis?
Velocity of money is key. It's essentially how quickly money changes hands in an economy over a given period. In a stable economy, this rate is relatively predictable.
But not in hyperinflation.
No. In a hyperinflationary environment, people lose all confidence in the currency and try to get rid of it as fast as they can, exchanging it for real goods or more stable currencies. This rapid turnover means that even a large increase in the money supply can lead to a far, far larger increase in prices because each unit of currency is being used and reused at an incredibly accelerated rate.
How fast did it get?
The author cites estimates of money velocity reaching astoundingly high levels in Weimar Germany, with the average mark changing hands dozens of times within a single day near the peak. Just incredibly fast.
He shares a particularly poignant anecdote about a woman named Frau Eisenmenger who lost her entire life savings, which were held in government bonds. What does her story really illustrate about the devastating impact of hyperinflation?
Frau Eisenmenger's tragic experience vividly demonstrates the complete destruction of savings and fixed income investments that hyperinflation causes. Her government bonds, which once represented a lifetime of hard work and financial security, became utterly worthless.
Couldn't even buy bread.
Couldn't even purchase basic necessities. This highlights how hyperinflation doesn't just make things more expensive, it completely wipes out accumulated wealth and financial stability for ordinary people, especially savers and pensioners. Devastating.
The French occupation of the Ruhr Valley in 1923, due to Germany's failure to meet its reparations obligations, was another major shock. How did that particular event further exacerbate the already spiraling inflation?
The Ruhr occupation poured gasoline on the fire. The Ruhr Valley was the industrial heartland of Germany. The French occupation crippled German industrial production.
Supply shock.
A massive supply shock, yes. It led to a period of passive resistance by German workers who went on strike, supported by the government, who paid them by printing even more money.
Oh boy.
So you had this dramatic reduction in the supply of goods at a time when the government was printing ever more money. This created even more severe shortages and pushed prices even higher throughout the rest of Germany, further accelerating the hyperinflationary spiral. Supply shock colliding with massive monetary expansion.
The examples of the extreme price increases during that period are just mind-boggling. Champagne costing tens of thousands of marks, bread eventually costing billions. It's almost impossible to imagine.
These extreme examples truly underscore the catastrophic loss of purchasing power. Everyday items become so incredibly expensive in nominal terms that the numbers themselves become meaningless. A wheelbarrow full of cash for a loaf of bread. It highlights the complete breakdown of the currency's ability to function.
The author also mentions the rise of barter and the overall breakdown of normal economic activity during that time. What does that tell us about how a society functions when its currency collapses?
When a currency loses its value so rapidly and unpredictably, it effectively ceases to function. People lose all trust in it. They're forced to revert to more direct, but often very inefficient forms of exchange, like bartering goods and services directly.
Back to basics.
Pretty much. This breakdown of the monetary system severely disrupts normal trade, investment, and overall economic activity, leading to significant hardship and inefficiency. Society starts to break down.
The Reichsbank's response to this crisis was, incredibly, to print even more money, leading to this exponential increase. What were some of the devastating social consequences, things like hoarding, the rise of black markets, even widespread starvation in urban areas?
Yeah, the Reichsbank just kept going. As people anticipated further rapid price increases, they began hoarding essential goods, trying to stock up before things became even more expensive.
Creates shortages.
Exactly. Which led to shortages in regular markets and the development of thriving black markets where goods were available, but often at even higher exorbitant prices. The shortages of food became particularly severe in urban areas, leading to food riots and, tragically, even instances of mass starvation as farmers became unwilling to sell their produce for a currency that was losing its value by the hour.
It's quite chilling to learn that this period of extreme hyperinflation also contributed to the rise in popularity of radical political groups like the Nazi Party. How did such economic chaos create an environment for that kind of extremism?
The extreme economic hardship, the widespread social unrest, the loss of savings, the profound sense of political instability, it created a very fertile ground for extremist ideologies to take root and grow.
People looking for answers? Any answers?
Desperation. Exactly. The widespread anger, desperation, and disillusionment with the existing political and economic systems led many people to seek radical solutions and to look for scapegoats to blame for their suffering. The Nazi Party, with its nationalist and anti-establishment rhetoric, gained significant traction and popularity during this period of intense crisis and upheaval. Economic chaos breeds political extremism.
Finally, the hyperinflation in Weimar Germany did eventually end with a monetary reset in late November 1923. What was the key to finally stabilizing the situation, and what were some of the long-lasting consequences of that period?
The stabilization came with the introduction of a new currency, the Rentenmark. It was somewhat controversially, notionally backed by land and other physical assets, but the key was really the strict limits on its issuance and a restored sense of confidence.
A credible anchor.
A credible anchor, however tenuous. This helped to restore a degree of confidence and allowed for inflation and money velocity to come back under control, quite remarkably quickly, actually. However, the hyperinflation left very deep scars on German society. The economic devastation, the wiping out of the middle class's savings, the social and political turmoil it contributed to a lingering resentment and instability that unfortunately played a significant role in the political landscape of the following decade, including the rise of Nazism.
The author then lays out a rather sobering list of parallels between Weimar Germany in the lead-up to its hyperinflation and the present-day United States. It's quite a concerning list. What are some of the key similarities he points out that we should be aware of?
It is a sobering list, and it's presented not as a prediction, but as potential warning signs. He points to things like a costly and arguably lost war-thinking Afghanistan-Iraq, exponential growth in the money supply in recent years, especially post-COVID.
M2 growth, yeah.
Right. Emerging inflationary feedback loops, rising actual inflation rates recently, increasing political polarization and social division, a sense of social decay, growing wealth inequality, homelessness among veterans, rising xenophobia.
It's quite a list.
It goes on. The apparent end of a long-term debt cycle, significant political turmoil, widespread profiteering, capital flight, a decline in domestic manufacturing, shortages of certain goods, an evaporating middle class, rapidly rising asset prices alongside struggling real economy, stock market speculation, concerns about corruption, central banks actively buying government debt, QE,
And politicians may be downplaying inflation.
and a tendency among some politicians to deny or downplay the severity of the worsening inflation. It's a stark set of potential parallels to consider, even if the context is different.
He then takes us back further in U.S. history to discuss the Panic of 1907. Why is this particular financial crisis a relevant example when we're talking about financial gravity and the Federal Reserve's current dilemma?
The Panic of 1907 is relevant because it really exposed the inherent fragility of the fractional reserve banking system in the U.S. before the establishment of the Federal Reserve.
No central bank backstop.
Exactly. Over-leveraged trust companies faced defaults, leading to widespread bank runs and a significant contraction of credit throughout the economy. It clearly demonstrated the need for a mechanism to provide liquidity to the system during times of crisis and to prevent these cascading failures.
And J.P. Morgan had to step in?
Yes, it famously required the personal intervention and financial resources of J.P. Morgan to help organize a private bailout and stabilize the system, underscoring the lack of a formal lender of last resort at that time. This panic was a major impetus behind the creation of the Fed just a few years later.
And the creation of the Federal Reserve in 1913 was specifically intended to address these kinds of issues, to act as that lender of last resort, and to provide what was termed an elastic currency, meaning the money supply could be adjusted to meet the needs of the economy. But the author reminds us again of this concept of moral hazard that's associated with the Fed's existence.
Yes, and that's the double-edged sword. While the Fed was created with the noble goal of stabilizing the financial system and preventing panics, its very role as a backstop, as the lender of last resort, can inadvertently create moral hazard.
How so, again?
Banks and other financial institutions might be tempted to take on greater levels of risk, knowing that the Fed stands ready to intervene and potentially bail them out if things go wrong. This can lead to a buildup of systemic vulnerabilities over time because the potential consequences of excessive risk-taking are somewhat mitigated by the expectation of a Fed rescue. The safety net encourages riskier behavior.
The Great Depression further shaped the Fed's role with the creation of the Federal Deposit Insurance Corporation, FDIC, and the expansion of the Fed's powers, including open market operations. How did the severe deflationary spiral of the Depression really highlight the potential role and responsibilities of the central bank?
The Great Depression was a brutal lesson. It was significantly worsened by a massive destruction of money within the banking system through widespread bank failures, a sharp contraction of credit, deflation, and hoarding of cash.
Money disappearing.
Literally disappearing from the system. The creation of the FDIC was a direct response to the bank runs, aiming to restore public confidence. The expansion of the Fed's powers, particularly the ability to conduct open market operations buying and selling government securities in the open market, gave the central bank a more direct and powerful tool to influence the money supply and interest rates.
Trying to fight deflation.
Exactly. It was recognition that the central bank needed to actively manage the money supply to prevent such devastating economic collapses, particularly deflationary ones.
This brings us to the Federal Reserve's so-called dual mandate of maintaining price stability and maximum employment. How can the pursuit of these two seemingly beneficial goals sometimes create a real tension for the Fed?
The dual mandate often puts the Fed in a difficult spot. The monetary policies that might be most effective in promoting full employment, like lowering interest rates and increasing the money supply to stimulate activity, can sometimes lead to higher inflation, thus undermining price stability.
And the reverse.
And vice versa. Policies aimed at curbing inflation, like raising interest rates, can slow down the economy and potentially increase unemployment. The Fed constantly has to try and find a delicate balance between these two often competing objectives. It's a complex balancing act with no easy answers, and they often get criticized whichever way they lean.
The author then introduces this concept of financial gravity, likening debt to economic mass. Can you elaborate on what this analogy is meant to convey?
The financial gravity analogy is interesting. It suggests that the accumulation of debt acts like a gravitational force on the economy. Just as objects with more mass exert a stronger gravitational pull, economies with larger burdens of debt become more susceptible to economic downturns, particularly credit contractions and deflationary pressures.
Debt weighing things down?
Exactly. Initially, taking on debt can stimulate economic growth, like escaping Earth's gravity. But as the debt level becomes excessive, the weight of servicing that debt, the interest payments, and the increasing risk of defaults can begin to outweigh the benefits, potentially pulling the economy downwards into recession or even depression.
Yeah.
Too much debt becomes a drag.
He makes the point that governments that issue their own currency can't technically default on their debt in nominal terms, but they can effectively devalue their currency through excessive money printing, leading to inflation. What's the key distinction we should understand there?
Right, the difference between nominal and real default. A government that controls its own printing press, like the U.S., can always, in theory, print more money to pay back its debts in the stated face value, the nominal amount. So technically, they don't have to default.
They can always make the payment.
They can always create the dollars to make the payment. However, if they resort to printing excessive amounts of money to do so, it will almost inevitably lead to inflation, which erodes the real purchasing power of that currency.
So you get paid back, but the money's worth less.
Precisely. So while the government might have technically repaid its debts in nominal terms, the value of the money they used, and thus the real value of the holdings of their creditors, bondholders, will have been significantly reduced. It's a form of default through inflation, a real default on purchasing power, rather than an outright refusal to pay.
The author notes the ongoing trend of increasingly lower interest rates in the United States over the long term and the corresponding significant rise in public debt to GDP. He suggests that the Fed may be intentionally suppressing interest rates to help keep the Treasury solvent. Can you explain that line of argument?
This is a controversial but increasingly discussed idea. The argument is that as the total amount of U.S. government debt has grown so substantially over the decades, historically normal levels of interest rates would now result in an enormous, potentially unsustainable burden of interest payments for the Treasury.
The interest cost would be huge.
Exactly. These payments could become so large that they crowd out other spending or even trigger a fiscal crisis. Therefore, it's argued that the Federal Reserve has been, perhaps implicitly, incentivized to keep interest rates artificially low through its monetary policy tools. QE, low policy rates, effectively subsidizing the government's borrowing costs and preventing those interest payments from spiraling out of control, keeping the government's interest bill manageable.
This leads to his analogy of a financial black hole. What does that represent in this specific context of debt and interest rates?
The financial black hole analogy describes a potentially dangerous feedback loop. Lower interest rates might initially seem like a solution to manage high debt, but they can also encourage even more borrowing, further increasing the overall debt burden.
Cheap money leads to more debt.
Right. This then necessitates even lower interest rates in the future to keep the cost of servicing that larger debt manageable. This creates a situation where it becomes increasingly difficult to raise rates back to normal levels without triggering a potential debt crisis or severe recession.
Trapped.
The economy becomes ever more reliant on these low rates, and the central bank's ability to normalize monetary policy becomes increasingly constrained, like being pulled into a gravitational field that's hard to escape. The Fed loses its room to maneuver.
He points to the Federal Reserve's attempt to begin tapering its asset purchases and raise interest rates in December 2018 as an example of this. What did the market reaction to that attempt indicate about this financial black hole?
The market reaction in late 2018 was quite telling. The significant market downturn, the taper tantrum sequel, that occurred in response to the Fed's modest attempt to tighten policy, just slowing QE and raising rates, slightly strongly suggested that financial markets had become highly addicted to the constant liquidity injections.
The market couldn't handle it.
It seemed that way. It indicated that even a small move towards tightening could trigger a rapid and negative repricing of assets, highlighting the sensitivity of the highly indebted financial system to any withdrawal of central bank support. It seemed to confirm the idea that escaping this low-rate, high-debt environment might be very challenging without significant market disruption. The Fed quickly reversed course.
The author concludes this section by observing that each successive economic crisis seems to require exponentially more stimulus from the Fed and the government, and he presents the Fed's current dilemma in stark terms. Either they continue with QE and risk hyperinflation, or they taper and risk a collapse in asset prices. It certainly sounds like they're caught between a rock and a very hard place.
Exactly. That's the crux of the dilemma as presented. The fact that each crisis, LTCM.com bust 2008, COVID seems to require larger and larger interventions, suggests that the underlying vulnerabilities, the high debt levels, the reliance on low rates, aren't being resolved and may even be worsening.
Kicking the can down the road, but the can gets bigger.
That's one way to put it. The Federal Reserve now faces a truly difficult choice, with potentially severe negative consequences, regardless of which path they ultimately decide to take. Continue printing and risk currency debasement, or tighten and risk a deflationary debt collapse. A very tough spot.
So to summarize our deep dive today, we've explored how the US dollar's position as the dominant global currency, while offering certain benefits, also contains inherent contradictions and risks, most notably the Triffin dilemma.
Right. The need to supply dollars leads to debt.
The sheer scale of debt that has accumulated globally, coupled with the intricate and potentially volatile world of financial instruments like derivatives, creates significant systemic vulnerabilities within the financial system.
That nitroglycerin analogy, the interconnectedness.
The historical example of the Weimar hyperinflation serves as a stark warning about the potential consequences of unchecked monetary expansion, even though the specific circumstances of today are, of course, different.
History doesn't repeat, but it often rhymes, as they say.
And ultimately, the Federal Reserve finds itself facing a set of very challenging choices
Yeah.
with potentially far-reaching implications for the future of the global economy, caught between inflation and deflation.
Precisely. Understanding these underlying dynamics, even at a high level, is incredibly important for you, the listener, as you navigate your own financial decisions and try to make sense of the often confusing broader economic landscape. It's not just abstract theory.
So here's a provocative thought to leave you with as you go about your day. How sustainable is the current global monetary system in its current form over the long run? Given the historical precedents we've discussed, like Weimar, and the very real dilemmas that central banks around the world are now facing, what could be some of the potential long-term consequences of the choices that are being made right now?
Big question.
What aspects of the Weimar Republic's descent into hyperinflation resonate most strongly with our present-day situation, if any? And what specific indicators might you be keeping an eye on in the months and years ahead?
Lots to think about there.
We really encourage you to explore this dollar endgame analysis further if you found this interesting, as well as other related research, to deepen your own understanding of these critical issues. It's a conversation that is undoubtedly going to continue.